Good morning, students. I welcome you all for the online class of business studies. Today we will be going to learn the topic business finance. The sources of business finance. In that we will be going to continue that short-term finance. The finance required for a short period up to 1 year is known as short-term finance. This type of finance is generally needed for fulfilling the needs of short period of time. Features of short-term finance are these short-term finance are used for current assets purchase and other things. That's why working capital requirement, if we are not having, then we can have the current short-term finance. This type of fund is required to meet day-to-day requirements such as holding of stock of raw materials, spare parts, etc. It is more often called working capital. The amount of short-term finance a firm requires depends upon the nature of the undertaking, time gap between the production of goods and selling of sales, and the volume of business. Generally, trading companies require more of short-term finance as compared to manufacturing companies. Common sources of raising short-term finance are credit granted in trade, short-term loans from commercial banks, etc. Sources of finance on the basis of ownership. When we see for every business enterprise, there are two sources of business finance. These are very first owners fund, second borrowed fund. When we go to the owners fund, student, this is the type of fund which is required for the business, and it is generally invested by the owners of the business, means in the form of shares. Those who are purchasing shares of the company, they become the owner of the company. That's the money which is invested by them. It is known as owners fund. So owners fund is nothing, student. It refers to the fund contributed by owner as well as accumulated by the profit of the company. It is known as owners fund. So there are two things. One is owner's capital, owners has accumulation. Second, accumulated capital, profit of the company. This fund remains with the company and it has no liability to return this fund. For example, equity shares, retained earnings, etc. Now we will be going to learn one by one all the owners fund. Before that, we will be going to learn main features of owners fund. When we will be going to learn the main features of owners fund, the main features are as follows. Very first, source of permanent capital. The owner's fund remains permanently invested in the business. It is not refundable like loan or borrowed fund. Apart from a large part of owner's fund is used for acquiring fixed assets. This type of finance is available for all purposes throughout the life of a business. That is known as source of permanent capital. So the main features is in that only the very first feature is very important, that is permanent capital. As owners are the real people of the business, they will not quit the business till the business will come to a closure. So that says that the investment or the capital contribution by them is considered as permanent capital. So owner fund is a permanent source of capital. Provision of risk capital. Definitely, student, owners fund is also known as the risk capital because uh, um, has the return on this capital depends upon the rate of earnings of the company. If the company is not able to earn the profit, it means loss, then it is not compulsory to pay back to pay any amount to the equity shareholders or the owners. If loss continues, owners may be unable to recover even their original investment. In times of prosperity, high level of return is given on owners fund. So there is two things. When there is a boom period, surplus profit is shared among the owners, and when there is a loss situation, that is also have to be borrowed by the equity shareholders or the owners of the business. In times of prosperity, high level of return is given on owners fund. The return on owners fund varies from the profit earning of the company. That is why it is called risky capital. Next is no security required. No security is required to be offered against ownership capital. Sources of owners fund. The owners fund comprises of share capital, retained earnings, accumulated profit. We will be going to learn this in the further classes. Very first, we will be going to learn what is borrowed fund. Borrowed fund, when we talk, student, at the some of the time when we are not able to increase our capital through the way of shares, we can borrow the money from the market. That is known as borrowed fund. It includes all funds available by ways of loans or credit. Features of borrowed fund capital, when we see, very first feature is that it is having a fixed time. Definitely, the borrowed fund is raised by business to firms for specified period of time. This fund may be raised for short term, medium term, and long term. Security. Generally, firms can get borrowed funds against the securities of assets. Banks and financial institutions offer loans on different terms against the security of assets. Regular payment of interest. It is legal compulsion on business firms to pay a regular amount. Like for example, we have taken finance from bank. Though we are not paying the principal amount now, but the rate of interest every month it is compulsion on us to pay in the given period time. The payment of interest as well as principal amount is legal liability of a company irrespective of its earning. Control. From control point of view, when we see the borrowed fund security holders do not get the right to control the manage activities of the business firm. They have the right to sue the firm in case there is default in payment of interest or repayment of loan amount. Sources of borrowed fund, when we see sources of borrowed fund are debentures, loan except from commercial banks, loan from financial institutions, public deposit, intercorporate deposit, trade credit, etc. These are considered as sources of borrowed fund. Next, so these were the features of the borrowed fund. Let us proceed with the sources of raising finance through the ways of owned fund and the borrowed fund. Companies can raise finance from the following sources. Very first, retained earnings. Second, trade credit. Third, public deposits. Fourth, shares, equity shares and preference shares. Fifth, debentures. Sixth, commercial banks. Seventh, financial institutions. Eight, international financing. When we see retained earnings, profit, owners fund, long-term finance. Let us see one by one what are things. It is retained earning or profit is a owner's fund first of all. Okay, what is retained profit? The accumulated source of profit which the company have gained during the period of surplus period. Instead of distributing to the shareholders the surplus part of the profit, the company has, with the consent of the shareholders, they had kept that particular part of profit for the future growth and expansion of business. That part of profit is known as retained earning, or it can be said accumulated profit. And thus retained profits are also known as plugging back of profit. Retained earnings, self-financing or international financing, reserve or surplus. Retained earnings refers to undistributed profit after payment of dividend and taxes. It provides the basis of expansion and growth of companies. It is considered the most important source of finance. Since it is internationally generated, the best method of financing is known as self-financing also. Features of retained earnings, when we see the various features of retained earnings are as follows. Very first, cushion of security. Definitely it is a cushion of security because this that part of the surplus profit which the company is keeping, and there is no risk of returning back to the equity to the shareholders of the company or the owners of the company. So retained earnings are considered as a cushion of security because they provide support at the time in time of adversity when companies are not finding it difficult to collect the funds finance from any other source. Funds for new and innovative projects. The retained earnings are a common source of funds for financing risky and capital innovative projects. This fund is generally used for research work, expansion projects, etc. Medium and long-term finance. Retained profits is considered as an ownership fund. It serves the purpose of medium-term and long-term finance. Conversion into ownership fund. The surplus retained earnings can be converted into share capital by issue of bonus shares. In issue of bonus shares, there is no outflow of cash. Investors too are benefited by the issue of shares free of cost. Next, we will be going to learn is the merit advantages of retained earnings. When we will be learning the merits of retained earning, there are as follows. Very first, this source of finance has the following advantages. Very first, most dependable source. Definitely, student, this is the most dependable source of finance at the time of financial crisis or in the expansion of the business when company is not able to get any type of outer side source of income. So as an internal source, there is more dependable upon the external source of finance. The external source depends upon the preference of the investors, market conditions, etc. No cost. Raising of retained earnings and its use do not involve any cost to be incurred, as there are no expenses on prospectus, advertising, etc. So that point of view, it is very good, as it doesn't cost no extra cost. No fixed liability. There is no fixed liability commitment to pay dividend or interest on this source of finance or fund, as retained profits are a company's own money, so they don't have to pay to they are not having any liability to pay back to the owners. No interference. Definitely has within retained earning there is no increase in the number of shareholders, so the control of the organization will be in the hand of existing shareholders. There is no diversification or an exchange of control from one person to another. So that is so no interference is there. Retained earnings involve no risk of dilution of control. No security. Definitely for getting retained earning we don't have to mortgage any security asset has security. So that is a good point about like debentures. No charge is created against this asset. The company is free to use this asset for raising loans in future. Goodwill. The retained earnings add to financial strength and improved credibility of the business. With the large reserves, company can immediately meet all types of unforeseen contingencies and any other crisis. So that is about good about the retained earning. As company will be getting benefit, the people will be easily believing on the company as the company is increasing the capital in the form of retained earning. The next part we will be going to learn as a features of retained earnings. Demerits, disadvantages of retained earning. When we will be seeing the various disadvantages of retained earning are as follows. Very first disadvantage is that careless use. The as it is said, the accumulated part of the profit which the company is not keeping for the expansion of the business, but still it is not used with the proper care. As the company thinks this money is there, the management of the company may not always use the retained earning in the best interest of the shareholders. It may misuse them by investing in unprofitable or undesirable investment proposals, because company find that this is the money which is accumulated from many years, so they can be utilized for any purpose, and that time they when the money is easily available to them for any type of project, they, some of the time they not even check the risk with the projects, with the dependency of the project, that they do not check. Dissatisfaction among shareholders. Large retained earnings may cause dissatisfaction among the equity shareholders as they do not receive high rate of dividend at where a huge amount of surplus profit is kept aside in the form of reserves. Instead of giving to them the surplus part of the equity, part of the profit, it is accumulated in the business as accumulated or retained earning. So some of the time it become question and it become conflict between the equity shareholder, some of the equity shareholders, that why the money is not given them as the extra dividend instead of keeping in the company has accumulated profit. Overcapitalization. Unnecessary every year. This accumulated profit will be showing higher capital as compared to existing capital. Large amount of returning results in issue of bonus shares to equity shareholders. Frequent capitalization of reserves may result in overcapitalization. Imbalanced growth. When surplus profit are not distributed in the form of a dividend, it results in use of profit by the same industry for its further growth and expansion. When the surplus profit is distributed in the form of dividend, then the shareholder may invest the money in other companies, resulting in balanced growth of all the companies. So there is a very imbalanced growth. Some of the time, some of the companies they are not able to grow a balanced way in when they are using the retained earning. As it is said, when surplus profits are not distributed in the form of dividend, it results in use of profit by the same industry for its further growth and expansion. When the surplus profit is distributed in form of dividend, it means if the shareholders will be getting this part of the dividend surplus profit, they can utilize it for the investment in the same company as well as in the investment of other companies. But as it is not given in the form of dividend to the shareholders, instead of that, it is kept as accumulated profit in the same industry. It means the growth and expansion of the same industry can be possible. There are many industries in the society which needs financial help. That financial help can be provided if the shareholders are getting extra dividend, so that they can invest in this company as well as in other companies. That is not possible when the companies are ready to submit a particular profit in the form of accumulated profit. The second part of the ownership is borrowed fund, that is trade credit. Okay, trade credit has name is there, the credit which is given at the time of trade, like for example when the wholesaler is purchasing the goods from suppliers, The supplier gives them the credit for some time. That is known as trade credit. In the business, one organization or one branch is giving it to another branch, to another organization some financial help. It is known as trade credit. Trade credit refers to an arrangement whereby a manufacturer is granted credit from the supplier of raw materials, inputs, spare parts, etc. The supplier allow their customer to pay their outstanding balance with a credit period. Generally, the duration of trade credit is 3 to 6 months, and thus it is a short-term financing facility. The availability of trade credit depends upon first nature of the firm, second size of the firm, third status or creditworthiness of the firm. When we see the merits of trade credit, the merits of trade credit are as follows. Very first, readily available. The trade credit is easily available because it is supplied with the by the suppliers of the goods. So trade credit is available without any special efforts on the part of a manufacturer or trader. Flexible. There are no rigid rules and regulations involved in trade credit. It can be easily adjusted with the changing needs of the customers. Purchases, as time of payment is generally adjusted in view of past dealings. No flotation cost. No extra cost is incurred, like in whether at the time of issue of shares and debentures. Flotation cost is also incurred by the people, by the businessman for issuing the shares. But in this trade credit, no flotation cost is involved in arranging trade credit. So these are the merits of trade credit, that is readily available in the market. It is flexible enough to change because as per the changing needs of the time of payment, generally adjusted in view of past dealings. Limitations of trade credit. Increases in prices. As the supplier is giving the trade credit to the manufacturer of the goods, but he will be charging the price of the raw material in the day when the payment will be made, not on the day when the goods has been taken. So that can be done. So this is a drawback of trade credit. Sometimes the supplier may increase the price of commodity or raw material supplied if he is selling goods on credit. So that can be taken. Legal action. In trade credit, the buyer generally issues a promissory note, and in case he fails to meet his commitment, the supplier can take legal action. So that is the legal action. Next is the public deposit, borrow for medium term finance. When we see student public deposit, as the name is public deposit, the deposit which is made by the public in the companies are known as public deposit. It refers to unsecured deposit invited from the public. A company wishing to invite public deposit places an advertisement in newspaper. Generally, these companies are the government companies. Any member of the public can fill up the prescribed form and deposit money with the company. Features, characteristics of public deposit. When we see, very first feature is unsecured. Companies mortgage or no assets against the public deposit raised from the general public. Finance of working capital. The amount raised from public company deposit is generally used by the company for meeting the requirements of working capital. Though there are a primary source of short-term finance, but by renewing this, they can be used for a medium term also. Time period. Public deposit can be invited for companies for a period of 6 months to 3 years. Simple procedure to raise. Public deposits are simple to raise. A company simply has to place an advertisement in the newspaper. Any member of the public can deposit money with the company by filling a prescribed form. The company issues a simple deposit receipt in return, and on the results of the receipt, the terms and conditions of the deposits are printed. Repayment. A company which has public deposit is required to set aside 10% of the deposit maturing by the end of the year. The amount so set aside can be used for repaying public deposits. So this was the public deposit, student. Merits and disadvantages of public deposit and other types of borrowed and owner's bond. We will continue in the next class. For today's class, this much only. Thank you and have a nice day.